Expense journals are processed when a company incurs expenses. These need to be captured or recorded. It's that simple again. So let's jump right into the examples. Cassava SmartTech has incurred salaries expenses of $3 million for the current month. What would the journal entry be on the last day of the month when salaries are paid? Easy. Firstly, there would be a debit to the salaries expense in the income statement. Salaries are an expense. And then there will be a credit to the bank and cash in the balance sheet. That credit reduces the amount in the bank because it's paid out to the employees as salaries. And if you had to see the journal reflected in the GL and T accounts, you'd see a debit of $3 million in the salaries expense T account and a credit of $3 million in the bank and cash T account. Let's do another example. Jumia has purchased $15 million worth of fertilizer from a major supplier. They've purchased this for cash. It has managed to sell this fertilizer onto farmers during the same period for $20 million in cash. What would the journal entries Jumia would process? Firstly, when they purchased the fertilizer, they would have debited inventory, $15 million, to show that they now own this fertilizer. And because they had paid for cash, they would credit the bank and cash account by $15 million to show the money that went out to pay for the fertilizer. They would then debit the cash and bank account $20 million when they sold the fertilizer because they received the money in cash and it would increase how much money is sitting in their bank account, and they would credit the revenue or the sales in the income statement, the equivalent of $20 million as well. They would also have to reflect their cost of sales, and they would do that by debiting their cost of sales, $15 million, and they would at the same time reduce their inventory, credit their inventory in their balance sheet, the equivalent of $15 million. How would this be reflected in the T accounts? For the first journal, there would be a debit of $15 million in the inventory T account and a credit of $15 million in the bank and cash T account. For the second journal, there would be a debit of $20 million in the cash and bank T account and a credit of $20 million in the revenue T account. For the third journal, there would be a debit of $15 million in the cost of sales T account and a credit of $15 million in the inventory or fertilizer T account.